We spend so much time obsessing over the Federal Reserve.
Yeah,
Every word from the chairman, every dot plot, every quarter point shift, it just dominates the headlines.
it does.
While everyone is watching the front door, looking for the Fed to cut rates, there's this massive structural machine operating out the back door that's actually financing the rally we're seeing.
It's the elephant in the room that nobody talks about until it starts smashing the furniture. We're talking about the divergence between the U.S. and, well, Japan.
Right. And specifically, we're looking at a source today titled The Honey Trap of the Japanese Yen, the Carry Trade Strategy. And I have to say, the honey trap framing is perfect because on the surface, this looks like the easiest money in finance. But the source makes a really compelling argument that this isn't just a trading strategy.
No, it's a structural vulnerability for the entire global market.
A huge one.
It effectively argues that a significant chunk of global liquidity, the grease keeping the gears turning in U.S. equity markets, is actually borrowed time and borrowed money from Tokyo.
And the numbers are just staggering.
The numbers back it up. We aren't talking about retail day traders here. We're talking about a $500 billion flow.
$500 billion.
Yeah.
And that's the conservative estimate mentioned in the text. So let's get into the mechanics of this, because I think a lot of people know the term carry trade, but they might not realize just how aggressively it's being used right now. The premise starts with the spread.
It starts with the spread, but it's really about the divergence in central bank policy. So you have the U.S. Federal Reserve, which has held rates high to fight inflation.
Right.
So U.S. assets, whether that's a 10-year treasury yielding around, say, 4.2%, or the S&P 500 returning double digits, they're attractive. They pay you to own them.
Meanwhile, you look at Japan. And sure, they've moved out of negative territory, but the source highlights that their base rate is still sitting at 0.75%.
Which in the world of global finance is still effectively free money.
It's nothing.
Exactly. So the simple math the source refers to is this. If you are a global macro fund, why would you use your own capital? You borrow yen at 0.75%.
Okay.
You convert it to dollars. You buy a U.S. asset yielding 5%, 10%, or in the case of some tech stocks, a lot more. The spread, that difference between the cost of the loan and the yield of the asset, is your profit.
But here is where we need to, I think, deepen the picture, because if it were just a straight 3 or 4% spread, I don't think we'd be seeing $500 billion piling in.
No.
The source alludes to the fact that this trade is heavily leveraged. Institutional players aren't just doing this dollar for dollar.
I think that's key. If I have a 4% spread, that's nice. It beats a savings account.
Sure.
But if I leverage that trade, say, 5-to-1,
Yes.
Suddenly I'm looking at a 20% return on equity for doing nothing but arbitrage. And because the yen has been so consistently weak and volatility has been relatively low, funds have felt comfortable piling on that leverage.
It feels like the ultimate free lunch. You borrow the cheap currency, buy the expensive asset, and leverage it to the moon. But the source makes a critical distinction here regarding where this money goes. It's not just sitting in safe treasuries, is it?
No, and that's where the risk profile changes dramatically. The source describes this as hot money. Now, we should probably clarify that term for anyone who isn't deep in macro every day.
Okay.
This isn't foreign direct investment. This isn't Toyota building a battery plant in Kentucky or Sony opening a studio in California.
Right. FDI is sticky.
Yeah.
It takes years to plan and decades to unwind. You can't just sell a factory on an iPhone app.
Precisely. Hot money is portfolio capital. It's liquid. It moves fast. It's chasing yield. And according to the analysis in our source, a massive portion of this borrowed yen is flowing directly into U.S. technology stocks.
The source explicitly mentions the heavy hitters, NVIDIA, Amazon, Google. It's just fascinating to think about the correlation there.
It is.
We usually attribute the rally in NVIDIA to the demand for H100 chips or the AI revolution. And obviously, the fundamentals are there. But this suggests that the valuation the premium investors are willing to pay is being inflated by this cheap Japanese credit.
Well, it makes sense if you think about the nature of tech stocks. They are long-duration assets. Their value is based on future growth.
Right.
When the cost of capital is effectively zero because you're funding an array. Yen investors are willing to pay much higher multiples for that future growth. The source basically argues that these tech giants have become the de facto savings account for Japanese liquidity.
So in a way, the Bank of Japan has been inadvertently funding the NASDAQ rally.
Indirectly, yes. By keeping rates suppressed while the U.S. boomed, they created a siphon that sucked capital out of Japan and just sprayed it all over Silicon Valley.
Which brings us to the honey trap part of the thesis. Because if this were just a permanent state of affairs, we'd all be rich and happy. But the source identifies a trigger that can reverse this flow instantly. And it's not the interest rate itself, it's the exchange rate.
This is the mechanism. This is what turns the trade from a profit machine into a nightmare. We have to talk about the unhedged nature of this trade.
This is a crucial detail. So if you hedge the currency risk, if you buy insurance against the yen moving, does the trade still work?
Generally, no. If you were to fully hedge the currency risk using forwards or swaps, the cost of that hedge would roughly equal the interest rate differential. The market is pretty efficient that way. So to get that free lunch, you must take the currency risk. You have to be short the yen.
You're betting that the yen will either stay flat or, ideally for you, get even weaker.
Right. And for a long time, that was a great bet. That's scenario A in the text. You borrow yen, convert to dollars. The yen weakens. When you go to pay back the loan, the yen is cheaper to buy.
So you win on the yield.
And you win on the exchange rate. It's a double profit.
But the source warns about the flip side. The honey trap snaps shut when the yen strengthens. And this is where the math gets, well, brutal. Let's walk through scenario B.
Okay, so let's say the yen appreciates by 10% against the dollar. Maybe the Bank of Japan hints at a rate hike, or the Fed signals a cut. Suddenly, the yen spikes.
So I borrowed 100 million yen. At the start, that caused me a certain amount of dollars to pay back. Yeah. But now, because the yen is stronger...
Now you need more dollars to buy that same 100 million yen to clear your debt.
Okay.
Exactly. Your liability has grown in dollar terms. And remember that leverage we talked about earlier.
The 5-to-1 leverage.
If you are leveraged 5-to-1, a 10% move in the currency doesn't just wipe out your 4% interest spread. It wipes out 50% of your equity.
Wow. That is the definition of picking up pennies in front of a steamroller. You're chasing a 4% yield, but you're exposing yourself to a currency move that can just obliterate you in an afternoon.
And this is where the consequences section of the source gets really dark. It introduces the concept of the margin call, but deeper than that, it explains the feedback loop, the unwind.
The spiral. Because this doesn't happen in a vacuum, right?
Yes.
If one big fund gets in trouble, they don't just sit there, they have to act.
They have to sell. This is the sequence. The yen strengthens just a little bit. Risk models at these big hedge funds start flashing red. Their leverage ratios get out of whack. The banks lending them the money issue a margin call.
Post more cash, or we sell your assets.
And what are their assets?
Their assets are Amazon and NVIDIA stocks.
So they sell Amazon and NVIDIA. Now here is the critical step. They sell the stock for dollars, but they don't need dollars. They need to pay back a loan in yen.
Oh, right.
So they take those dollars and they have to aggressively buy yen.
Which creates more demand for the yen, driving the price up even further.
Which forces the next fund to get a margin call. And the next one. It becomes a self-fulfilling prophecy. The selling of U.S. stocks drives the U.S. market down. The buying of yen drives the yen up. The trade unwinds, and it unwinds violently.
It effectively reverses the flow of that $500 billion we talked about. Instead of liquidity pumping into the market, it's being vacuumed out to cover debts in Tokyo. The source describes this as a panic sale dynamic.
And we've seen previews of this. We've seen days where the yen spikes 2 or 3%, and then the NASDAQ drops 3 or 4% almost in lockstep. The source is arguing that this correlation isn't a coincidence.
No, it's the mechanics of the carry trade unwinding.
Exactly.
It really challenges the way we interpret market news. You might see NVIDIA drop 5% and think, oh, did they miss earnings? Is there a new chip ban? But in reality, nothing changed at the company.
Nothing at all. It's just a macro fund somewhere liquidating their portfolio because the yen moved against them.
That's the danger of hot money. It links asset prices to variables that have nothing to do with the asset itself. The stability of American tech giants becomes dependent on Japanese monetary policy.
It's a fragile link.
So let's talk about the trigger. The source identifies the exchange rate as the deciding factor, but what causes the exchange rate to move? We're in a weird moment right now where the Fed is looking to cut and Japan is looking to hike. That seems like the perfect storm for this trap to spring.
It's the convergence. For the last few years, the divergence was our friend rates high here, low there. Now, as the U.S. economy softens, the Fed wants to lower rates. That weakens the dollar. Simultaneously, inflation is finally showing up in Japan, so the Bank of Japan is under pressure to raise rates, and that strengthens the yen.
So the gap is closing from both sides.
Correct. And as that gap closes, the rationale for the trade just evaporates. If the spread drops from 4% to 2% and the risk of the yen strengthening increases, why hold the position?
You get out. But getting out means selling the U.S. assets and buying back the yen. So even the anticipation of the gap closing can trigger the unwind.
That's the psychological component. You don't wait for the fire to start, you leave when you smell smoke. And right now, there is a lot of smoke coming from the Bank of Japan. They are signaling that the era of free money is ending.
It's interesting to consider the scale of this. The source estimates over $500 billion. If that unwinds slowly, over years, maybe the market absorbs it. But if it happens all at once,
that's a liquidity shock. And markets can handle bad news, but they cannot handle a liquidity shock. When there are no buyers because everyone is rushing to pay back yen loans, prices gap down, that's when you see those flash crash scenarios.
I want to circle back to something the source mentioned regarding capital losses. It's not just about losing the profit from the trade. It's about the destruction of principal. For the individual listener, this feels abstract. Okay, some hedge fund loses money, but how does this transmit to the regular investor?
Well, do you own an S&P 500 index fund?
Sure. Most people do in their retirement accounts.
Then you are effectively long the carry trade because the S&P 500 is market cap weighted. It's dominated by those same tech giants, Apple, Microsoft, NVIDIA, Amazon, that are the recipients of these hot money inflows.
So if the carry trade unwinds and those stocks sell off,
the entire index gets dragged down with them.
That's a sobering realization. You think you're diversified because you own 500 companies. But if the top 7 companies are 30% of the index, and those 7 companies are the favorite targets of leveraged yen speculators,
then you aren't diversified against currency risk. You are implicitly short the yen.
It frames the global economy in a much tighter, more fragile way. We tend to think of these economies as separate silos. The U.S. is doing its thing, Japan is doing its thing. But this source paints a picture of a single, pressurized hydraulic system.
That's a good way to put it.
If you change the pressure in Tokyo, a pipe bursts in New York.
That's the reality of modern finance. Capital has no passport. It flows to where it's traded best. For a decade, it was treated best in U.S. tech stocks funded by Japanese debt. Now, the hospitality in Tokyo is getting a bit less welcoming.
The honey trap. It was sweet while it lasted.
But getting out is going to be sticky.
Before we wrap up, I want to touch on one final implication from the source.
Yeah.
It questions the sustainability of current market valuations. If we accept the premise that $500 billion of hot money is propping up prices, does that mean we are in a bubble or just an elevated state that can be normalized?
The source leans towards the idea that valuations are distorted. When you have artificial liquidity, and borrowing at 0.75% is arguably artificial in the current global context, you get artificial prices. The real price of an asset is what someone is willing to pay with their own money, not with money they borrowed for free.
So when the leverage comes out of the system, we might find out what these companies are actually worth.
We might. And that price discovery process could be very volatile. It doesn't mean the companies are bad. NVIDIA is a great company. Amazon is a powerhouse.
Of course.
But are they worth their current multiples without the yen carry trade support? That's the open question.
It's the difference between the business and the stock. The business is fine. The stock might be on borrowed time.
Exactly.
This has been a really illuminating look at the plumbing of the financial system. We started with the simple math of interest rate arbitrage, saw how leverage turned a 4% spread into this massive global engine, and walked through the honey trap mechanism that could bring it all crashing down.
And the takeaway isn't necessarily to panic and sell everything. It's to understand the risks you are actually taking.
Right. Knowledge is leverage.
In this case, literally.
So here is the thought I want to leave everyone with today. We all check the Dow, the NASDAQ, the S&P. Maybe we check the 10-year yield. But based on this source, there is another chart that should probably be on your home screen. If so much of your portfolio's performance is secretly tied to a currency trade halfway across the world, what happens to your retirement plan if the Japanese yen suddenly strengthens to 130 or 120 against the dollar? Is your financial future dependent on the Bank of Japan doing nothing?
It's the $500 billion question.
It certainly is. Thanks for diving deep with us today. We'll see you on the next one.